in a little bit of a
Oh,
different bubble here in Miami, being that we just have this domino effect going on, and this is all new for us. Actually, I have to tell you, every stage of real estate I've been in, it seems like it's all new. It's never ever, you would think, oh, okay, we've been through this before, but I've noticed every stage is different. And now we're going into this Miami growth stage where we have these big companies coming in like Google and all these other companies bringing their and and it's a process because it's happening slowly. So they're bringing their executives and then they're bringing their employees, and we do have a demand for housing, but we also have a lot of supply. So we're in that in between stage, which is really good because that means they really need us as realtors. And we're adjusting to all that. But I see the futures for Miami is going to be wild.
yeah.
Really is.
I support that as well. It's like the demand. People still want to come to the water, to the ocean, and have warm weather. And there's not a lot of people want to. A lot of people around the world want to be in the action versus coming further up north where there's more elbow space. So you're right on. Just from an outsider being in the mortgage on the mortgage side, the finance side, and seeing what's happening internationally and how people are still wanting to come to Miami. It's like how many friends can we make? And how well are we as service professionals staying at top of mind? So when these folks who are coming from around the world or even Miami and they want to scale up or scale down, when they think about real estate, they're thinking about you, right? How many people out there are doing that? And then I asked the question, and Patricia, you're really good at this. You're like a master brander, right? Because you understand the concept of posting content. People think about you when they think of real estate. It's then what is each individual doing to be at top of mind? So when the person thinks about buying or selling, they think about you as a real estate professional, right? And that's a different conversation. We spoke about that in the last training. But yeah, you're right on. I see the same thing, Patricia. Yep, you're on mute again, Patricia.
No, I
Oh,
mean, that's it. Yeah, no, that was just saying that we're in this very, very unusual time and we're trying to figure out how to navigate it and make the most of all this activity and people coming our way.
yeah.
And, we're in the process now creating very cool relocation packages. We're focusing on video. We're setting up a video room and a podcast room in the Brickell office. So
Oh,
we have all these new, we're really going hard on the social media. So everything to bring us attention right now that we possibly can.
yeah. And I'll add one thing. What you just said is really important. I think every if there is a real estate professional that's watching this, certainly, who has not recorded a 30 second to 90-second video of themselves at this stage in the game with the internet and where we are in commerce, it is so important to at least record a video. Why? Because old school is reading copy. What people want is they're on their cell phones, they're on their computers, mostly their cell phones, and they want to know who you are, what you sound like, what they're feeling when they look into your eyes. You have a picture, great. Okay. You have copy, also great. But you're taking it to another level when you're establishing a relationship by having a video where someone can hear the sound of your voice, feel your energy as you're speaking to them, look into your eyes, and it's helping strengthen the relationship. I get people who call me saying, "Hey, Jay, I went to your website, I watched your videos, and now I'm calling you." Right? Because of me engaging this way. So here you are again, Patricia, setting up resources for your your group and your agents to be able to bring in the business that they want. And I can't encourage you enough to at least utilize these resources and go record a video of yourself and put it on your website. Hey, this is what I do. This is what separates me. This is why you should call me when you are ready. And then whatever your value add is. And I'm happy to share with anybody who's watching this maybe some guidance or perspective on what I would do if I were you. I'm decent at that. I'm not an expert. I'm an expert mortgage guy, but I've been doing this like you, Patricia, for a long time, and I'm happy to add some insight.
Also, Jay is very happy to have you reach out to him with ideas one on one.
Yeah,
So
that's
if
true.
you ever do want that help one on one, he's very happy to have that.
Yeah.
So I'm going to turn it over now to you, Jay,
Okay.
to go through what you had planned.
Awesome. All right. So I'm going to go ahead and do a screen share here, and I'm going to take a second um, to set up the video as well. Hopefully we can see the video in here, and if not, then
While Jay's setting up, also don't forget we have a special meeting, a development meeting, which will be next Wednesday. Hansel, do you want to go over the details with everyone? I don't know. Hansel's on mute. Okay, it's going to be Kempinski Residences at noon, and we will be sending you the invites. So please reserve it. I'm sure if you haven't heard of the Kempinski name, it's like a five-star hotel now, residences known all over the world. And it would be a really, really nice addition to the Miami area. And that's where we'll be next Wednesday. So put it on your calendar.
and I think
Yes, I believe Google invites have been sent out and they'll continuously be sent out every day in the morning and more than likely in the afternoon to collect RSVPs. So check your emails, RSVP, let us know if you'll be making it next Wednesday at noon. I believe complimentary valet is also included.
okay. All right. I think we should be good to go here. Okay. Yep. Can you guys see my screen okay? Testing,
Yes,
testing. Okay.
yes,
Good.
yes, yes. Yes.
Okay, good. All right. Okay. All right. So then let's get into it. So this training today is to give you some insight on buyers or sellers who maybe are going to become buyers, or even sellers who need to access some cash, on how to get a mortgage if they can't use tax returns. There's a lot of folks I know in Miami that deal with brick and mortar banks. These some of them are large, some of them are small. You go in the big giant concrete building, and they typically require tax returns. And so you all know that at this stage in the game, there are products out there that don't require tax returns. I'm going to briefly go over some of these. And, you guys are the forgotten demographic here in real estate, realtors who are 1099, right? And so part of this is going to be useful for you as well. In addition to you being a realtor and helping your clients, like if you want to buy, whether it's your primary or investments yourself, like this will give you some insight for you. But you'll also be able to engage with prospective buyers, where someone might tell them no, what options they have. So we'll get right into it. Okay, so today's agenda: why self-employed and 1099 buyers get rejected, non-QM solutions. Okay, non-QM stands for qualified mortgage. You have conforming conventional and then non-conforming conventional, which is not Fannie Mae, not Freddie Mac. It's called non-QM. Most of you probably know that term, and if you don't, that's an important one to know. DSCR loans for investors, foreign national and ITIN lending, hard money and asset-based lending, the residential basics that we all know, the conventional FHA, VA, USDA, and jumbo, what a HELOC and cash out and renovation financing looks like. Commercial lending 101, just a very brief overview because I know sometimes, as you guys, especially in Miami, right, these higher end borrowers, they're self-employed and they probably, they're some of them are going to have commercial real estate, and you can actually engage with them because if they own commercial real estate now, then you have the ability to maybe help them with their real commercial real estate transaction as well. And the dollar amounts are on average much higher anyway. But at least you're not leaving anything on the table and you're serving your clients. So we'll go over that and then matching clients with the right product. Okay. So first, um, in the past, and you don't have, this is just more of a general question, but in the past, you have buyers that were told no. And then a lot of times we as service professionals, or I'll put myself in your shoes, it's like, okay, well, when you get approved, call me back, right? And they were told no by somebody who is not like me, where I have access to all the different products. Typically, people are told no from one of two places, either a brick and mortar bank, because they require tax returns, or a mortgage broker or mortgage lender who hasn't been in the business long enough to understand lots of nuances that take 15, 20 years of being in the business to know. So this is important. And ultimately, when we're talking about buyers who you have lost to a no, it's pretty much anyone who's self-employed who can't use tax returns. And you don't have to drop anything in the chat, but it's just kind of going back. It's like, wow, if I would have known you, Jay, back then when I was told a no, then I would have been able to serve the client, right? We're service professionals serving the client. And then as a result, you get to make a living. Okay. So why is this training different than mostly what you might be used to, where a lot of mortgage professionals might come in and say, oh, here are all of our products, but you can't teach creativity. You can teach what creativity is, but someone has to go through it. It's reps. It's like going to the gym. You can't go into the gym and do one rep and expect your body to be where you want it to be. It's consistency, showing up constantly, constantly. And this is no different. This is what 26 years, excuse me, 27, I need to change that. 27 years will do. And I'm still hungry. Like I still feel like a young guy. I'm in, I weight train and the whole thing. So it's like I feel like I'm in my early 30s and I'm scaling, which is one of the reasons I'm here doing this because I want your business. I'm prepared for it. I have the time for it. Self-employed borrowers, 1099 earners, investors, foreign nationals, commercial deals, this is what I use. This is what I'm about to show you is just the basics of how I get a lot of these really unique deals done. And it's not only the uniqueness of the deal, it's also the professional's ability. You were just saying, Patricia, how Anna Marie went through like a high stressful deal. And so there's not many deals that don't have some sort of hair on it in my experience, but how we respond, what our nervous system is when we're going through this can affect everyone else. So I have practices in place to be calm, have a calm nervous system. So when I need to deliver news that might not be pleasant, the borrower's feeling my energy and how am I approaching it, which is part of relationship building, which is part of our service. It's not just getting a contract and or getting a listing. It's how does the person feel as a result of working with us? And one of the ways that you can increase the odds of them feeling good is your own self practices and what you do to your nervous system to calm it down before you have a conversation is what works for me. Okay. So a lot of we think self-employed borrowers are too hard. They're not. They're underserved because a lot, as I mentioned, a lot of people don't know what they're doing when it comes to working with self-employed. I'm talking about mortgage professionals. A lot of times don't know what they're doing. And what happens is most real estate professionals walk away saying, well, it's too hard. Let me go deal with this cash buyer, right? Or something else that maybe you have some sort of level of judgment, no disrespect, of judgment that this is going to be too hard or this is going to be much easier. When if you have a thought in your mind that this is going to be too hard, what I strongly encourage, and this is whether you use me or not, maybe the borrower's bringing another mortgage professional to the table. If you have the feeling that it might be too hard or too difficult, reach out to me and say, hey, this is what I've discovered. What do you suggest? There have been many, many times where I'll talk to a realtor who's helping a borrower who's using another mortgage professional, where I'll say, just go ask this question, do X, Y, and Z. And then it goes from complex to smooth and easy, and everything shifts simply by the realtor reaching out and saying, hey, what do I do here? So it's really important, like anything, it's important to know that just because you're dealing with a mortgage professional who's licensed doesn't mean that they know everything and what their answer is the conclusion. Right? When you speak to me, it's likely I'm going to give the conclusion because I've got all the different components of age and experience and options and all these good things. But even then, I even sometimes say, hey, listen, based on my experience, this might be the issue. I'm not concluding, but most of the time I'm comfortable with concluding, which then helps you and the borrower or the buyer. Why banks say no. So it's important, I think, to understand why banks say no, because a lot of the brick and mortar banks, a self-employed borrower or buyer can have great credit, strong cash flow, and still get denied because the bank wants to see their W-2s or their tax returns. And I have tons of clients who make in the millions per year gross income, but their IRS shows under 100,000 as an example, and they want to buy a $3 million property. And IRS says they make 100,000. Well, that's not going to work. So the bank says, no, I'm sorry, you don't make enough money. If you file more income, which instead of making 100,000, you make a 500,000, then we have something. But that is counterproductive because the borrower sending in, and I still have this conversation. This is important. And same thing with you guys as realtors is you don't have to file lots of income with the IRS in order to get a mortgage. Because if you're filing a lot of income, less write-offs, then you have to write the IRS a large check. That check is going to go to the IRS versus if you structure it properly, that check that will go to the IRS goes in your bank account. Whether it's to scale your business or go to a vacation or whatever it is, it's just understanding the math of what's going to benefit you. And that's part of the purpose of this training is to let you know that you don't have to file a lot of income with the IRS and neither do your borrowers because there are options where you can use that money to go in and renovate the house that you want to buy, as an example. But this is why banks say no, because the tax returns aren't pretty. Okay, the fix. This is where non-QM lending comes in. And I think it's important to write this down because, I mean, it's been around for several years. Years ago, it was called subprime, which is when the mortgage market meltdown happened. Now they've switched the terminology to what's called non-QM, and it's definitely more rigid. Like they don't like 15, 20 years ago, they were like, oh, go get me a business card from Kinko's and I'll give you a mortgage. That's how it was. Nowadays, it's show me your bank statements. Show me that if you say you have a real company and show me that income is actually going into the company. And let me see your credit and and let me see where the cash is coming from the purchase. So there are still guidelines that require paper trails. But as I mentioned, you don't need tax returns for non-QM, and these are some of the products we're going to go over. Okay. And you can see they're fully legitimate, widely used, built for exactly the borrower's traditional underwriting rejects. Okay. So let's talk about the bank statement loan. Okay. And this is for anybody who's 1099 also. So 1099 and bank statement loan is very similar. 1099 is you're just producing a 1099. Like here are the two items. A bank statement loan is we're looking at 12 months of or 24 months of bank statements. We're looking at the deposits, how much money is coming into the bank statement. And that's what we're using to qualify for income. And you can see typically up to 90% LTV. So if we've got a borrower with a 660 credit score and we can't use tax returns, you can go buy something and put down 10%. And so here you are, real estate professional, right, who is getting income coming into your bank account, whether you use 1099 or bank statements. And now you know that you can go buy something with 10% down. Maybe get the seller to contribute closing costs, right? And so that's doable. And you can use, which is a different conversation. I'm not gonna get too far off topic, but you can use retirement money and take out a loan against your retirement money as the down payment. You don't need cash in your checking account to buy a house. You need access to liquidity, right? So where there's a will, there's a way, right? And so if you put yourself in the shoes of, hey, I'm going to go buy a house or I'm going to refinance, what do I need to do? And then you can use yourself as an example for your buyers. And when I say buyers, friendly, loving reminder, which I don't know how this is so often, but when you have a listing and your listing is going to sell their property, what are they doing after? Are they buying another property? Are they putting it in a 1031 exchange so they can buy something else? Like it is so important that when you're having your listing conversation, side note, write this down. And I'm sure all of you already know this. I'm giving you a reminder is when you sell this house, what are you going to do with the money? And typically they're going to buy something else. And it is ill-advised to take cash from a sale and pay for another house all cash in terms of wealth creation. Any financial advisor would advise a borrower, don't pay all cash for a house. It has to do with when our grandparents, et cetera, went through the depression because it's built in our mind that if we have a mortgage that they can foreclose, so pay cash for the house. No, the house is one of the only assets where you should be leveraging with the intention of more wealth creation. That's a different conversation, a different maybe webinar that we can do later. But ask the question, what are you going to do with the cash? If they're going to buy a new house, that's where leveraging comes in. And then I'm happy to engage and have a conversation of how they can leverage and why it would be to their benefit. $1 million in cash, 500,000 down payment, take out a $500,000 mortgage and use the other 500,000, put that in retirement or whatever. Okay. So that's just a little simple thing. But coming back to the bank statement loan, you see the guidelines. Like I can go down to a 600, I can go up to 90%. That doesn't mean I can get a 10% down loan with a 600 credit score. These are just basic guidelines to give you an idea of what's available. Okay. So for 1099 income loans, right? Anybody who gets a 1099, which also is people who work in a restaurant or realtors, right? I think there's the list right here. Yeah. Real estate agents, contractors, consultants, gig workers can qualify. There are people like when you guys go out to eat in Miami, right? You've got these people that are serving you, bartenders, and it's like, and they make good money in Miami, right? When those checks are three, $400, a lot of them make 70, 80, $100,000 a year as a bartender or a server. Those are candidates. And you might say, hey, how long you been, if you can start the conversation, have you thought about buying? You'll hear, well, I'm a waiter, I can't buy, or I'm a bartender, I can't buy a house. Incorrect. And part of this training is to let you know that that is incorrect and that you can convert them into someone. And wow, all of a sudden you come in as their angel and say, no, you can do something. I've got a guy who will talk to you and maybe set you up so you can do something. So keep this in mind. Okay. This is another really good one, asset depletion or asset based. Okay. So, especially in Miami, there's a good demographic of wealthy individuals. And what they do is they'll put these blocks of money, right? We were just working on a mutual client that guy has multi millions in the bank account, and his income is from the dividends. So he doesn't bring in income in the traditional way. He doesn't have fixed income or he doesn't have a pension. It's like he's got I think it's like $7 or $8 million in a certain account that generates interest, and then he takes most of that and rolls it back in. So that's not really looked at as income. Okay. Um, So asset depletion, this product, which I love, is for someone who doesn't bring in traditional income. There's not money coming into his or her bank account every month. They've got $5 million in a checking account or 10 million in a brokerage account or whatever the number is. The mortgage is based off of how much money is in that account. So for example, we'll take a $5 million brokerage account and we'll divide it by 60 as an example. Okay, which comes out, I don't even, I'm not even going to do calculate the math as an example, but let's just say it comes out to, well, actually, I do know it's about 100, it's about what is it, a million? It's about 70,000 a month, actually. Okay, $5 million. So now we're calculating a $5 million balance, and the income we're using is calculating $70,000 a month. So if they're buying a $3 million condo and the payment's going to be whatever, 20,000 or $15,000, we're using 70,000 in income because they've got 5 million in their checking account or their brokerage account. It's called an asset depletion loan. So when someone wants to buy real estate and they say, I can't buy, I don't have any income. Oh, do you have money in the bank? Because I can get a loan if you have money in the bank or wealth or whatever it is. So at least now you know up to 80% LTV. So 20% down. Credit score doesn't have to be the greatest, as you can see, 660. Okay, so that's a great product that's very underutilized. It's, usually people who are retired who have a boatload of money. Okay, DSCR loan. This is a very popular product in my world. Because it's for real estate investors. I work with a lot of investors, and a lot of the investors I work with, I also do loans for their primary residence, right? So if someone's going to buy an investment property, this is how it works. You don't have to really have any money in the bank account except for down payment. So on a DSCR loan, and you can write this down, DSCR stands for debt service coverage ratio. And what that means is that the ratio is based off of what the rental income is going to be and what the actual mortgage obligation is. Okay. So, for example, this is great for foreign nationals, right? And it's good for any investor who's wanting to buy an investment property, right? Or has an investment property. What we're doing is we're looking at, okay, you put down 20 I'm going to use the example of purchasing, right? You have a buyer who's purchasing an investment property. They're putting down 20% and then they're going to have a mortgage obligation and it's vacant. This is important. You should write this down. When we get an appraisal, we're getting what's called a 1007, a rent roll. A 1007 is a portion of the actual appraisal that is going to let the lender know what the expected rental income is going to be for the next 12 months. Okay, if someone signed a 12-month lease for that property you're about to buy that's vacant, what does the appraisal say the 12-month lease should be? That's the number we're going to use to qualify the income. Okay, so if the payment, let's say, is $5,000 and the rental income is $5,000, that ratio is 1.0. So 1.0 ratio, that works. If the rental is lower than the mortgage obligation, now it's negative DSCR. It still works, but it affects the whole mortgage. It might need more money down. The interest rate's going to be higher. And so the DSCR ratio is saying, here's the mortgage obligation, here's the rental income. What is that ratio? So the ideal ratio, and you can write this down, is 1.25%. And I say it's important to write it down because you as the real estate professional can be a big supporter in all of this to even determine if it's worth going under contract, which is to find out ahead of time what the rental income should be based on your opinion and your own research. Then at least we have an idea. Then we run the numbers with the purchase price, what the taxes are. We have an insurance agent who will let us know what insurance is. And we can mitigate, or we can make sure everyone's time is well invested simply by knowing these numbers ahead of time. Are we going to cash flow or are we not going to cash flow? This is how you do a DSCR loan. What's great about this is we don't care about bank statements or tax returns or W-2s, or we care about your income zero. What we care about is the income from what the rental is going to be. Okay, now one caveat to that. I just shared with you what a 12 with the numbers on a 12-month lease. There's another product for DSCR, which is a short-term rental. Very important to know. I encourage you to write it down. A short-term rental is Airbnb. Okay. It's a different type of appraisal, and the rates are going to be a little bit higher because it's more of an aggressive business model to do a short-term rental DSCR loan. And so what I always encourage is let's go into it with a long-term rental plan to make sure the rate is as low as possible. And if we need to flip it to short term, right? So we show positive cash flow, let's see what that looks like. And then we can compare that to if it's negative DSCR, what does that rate look like? So that's just essentially foreign language for saying I'll help figure out the math after. But what you can do as the real estate professional is get an idea of what you think the rental income is going to be ahead of time. And that's the DSCR loan. This is very, very popular. Almost all investors are doing this if they're buying a turnkey property. And you can see what the LTVs are. We can do as low as 20%. I actually have a product you can do as little as 15% down, but it's a very difficult deal. But I have that because it's most likely not going to cash flow at 15% down unless someone's getting the deal of the century. And then you can see the credit scores are low. But this is how investors scale is they sometimes they'll pay cash, then they'll do a cash out refinance on the DSCR loan. I give them a bunch of money. I've got a guy who built two construction loans from scratch, or two ground up construction houses. They're worth just under $1 million each. And he's doing the DSCR loan with vacant. He's taking out 75% of the value. So he's paying off the hard money loan from construction, and he's accessing about 150 in cash per property. And he's going to take that cash and he's going to go get another property. This is what investors do. They leverage and scale, leverage and scale. And working with investors, it's rinse and repeat. That's the DSCR loan. Okay. So foreign national loans, okay? A lot of you, especially in Miami, right? You have people coming from all over the world, and it's like sometimes I'm sure some of you have relationships set up with the brick and mortar banks. But sometimes there's some nuances, right, that are required, and the service. I don't want to judge anyone else's service, but essentially, if someone is not a U.S. citizen and they want to buy real estate or refinance real estate in the U.S., they're considered a foreign national. And a foreign national loan can be done easily, whether it's considered a second home or investment property. And here's the basic loan of values. It's going to require at least 25% equity, sometimes 35% equity, depending on the borrower. Again, it goes back to a lot of these foreign nationals think or feel that they have to pay all cash. But if they know they have the ability to leverage, which is not use their cash, then they're going from buying a second home or investment property, leveraging, and then buying a second investment property because they have more cash. Simply because you said, well, you don't have to pay all cash. You should speak to Jay because he might share something with you that will increase your wealth creation. Instead of spending all cash, leverage this, and then you can take the rest and go buy another investment property. Now you have two assets that are going up in value. And what does that do for you? You just did two transactions. And then when they're ready to sell the listing, then they'll come back to you for the investment sale if they do that. Okay, ITIN, an international identification number is what this is. For people maybe who do not have a social security, or in fact, for people who do not have a social security number, they have certain types of visas, etc. So if they've got an ITIN number, then we can use that as the citizenship in the way that we're moving forward. And you can see what the LTVs are, right? It's 20 to 25% down. Again, they don't necessarily fall in the foreign national product. An ITIN number is for someone who's going to buy their primary, because, little side note, a foreign national borrower can only buy a second home or an investment property. That's what they're capped to. They can't buy a primary residence because they're not a citizen. And so therefore, it's a little bit more complex and it requires a little bit more money down. And usually the rates are a little bit higher. On an ITIN loan, if someone's buying it as their primary residence, it shifts things to a primary residence where the cost of the money, the interest rate is going to be lower than if they do it as a second home a second home purchase, as an example. So this plays a role in the cost of the money if they can provide their ITIN number. And you're not expected to memorize all this. I'm going to send you this recording. I'm going to send you this PowerPoint. But ultimately, my intention is just to lay this stuff out to kind of plant the seed. But you're never required, in my perspective, to know this stuff because you're good. And Anna Marie, I just see your hand raised. I'm going to look at that. But it's important that my suggestion is you focus on what you're good at, and then you leave all of this to me, right? So you don't have to add more to your mind energy, which we already have so much thought happening anyway. But let me see. Marie, you had a question. Excuse me, Anna Marie, you had a question, I think, right? Where is that? Where's the
Yes.
chat?
Can we use that ratio, the 1.25, to calculate how much a property is worth? Let's say we're working with a investor buyer, and can we work it backwards? Like, okay, this property can be rented for $2,500 a month. What is a fair price?
Gotcha. Yeah. The answer is no. When it comes to and that's a good question. And correct me if I'm wrong. The question you're asking is, can we base the value off of the rental income?
Right.
Here's why the answer is no, because the value is based off of comparables. Well, when you're selling a business, right, the business value is based off of income, right? When it comes to real estate, the real estate in almost all cases is based off of, and sometimes in commercial, you might be able to get away with that. But when it comes to residential real estate, the appraisal is going to say, we don't care if this is an investment property or a primary residence. We're putting a value on this. So if you have to sell it to someone who's going to be buying a primary, if the investor or the lender has to foreclose, let's say, they want to have an idea of what they're going to be able to sell it for. What's the market value? And so the next person comes in might be a primary residence buyer, not an investor. So, excuse me. So with that being said, the simple answer is no. The appraisal just a normal appraisal, except it has an extra component to it that says, here's what the rent should be. And then that's going to help us get to our ratio. Does that make sense, Anna Marie?
I guess.
Okay.
Yeah.
Well, no, well, I want to make sure I'd rather you say yes, it is clear, because it's a great question. The simple answer is
It's
no. On the DSCR ratio, they're going to order an appraisal and they're going to want the as is value regardless of the rental
okay.
income. And
Okay.
then the other component to that is they're going to also determine in that 1007, that rent roll report, what the market rent should be based on what the market is suggesting the rent should be. And you guys should have some sort of intel on what rent should be. Because if that seller, for example, is saying, hey, Anna Marie, can you please come list my property for rent? Right? Then you're going to have to do your own research to find out, well, what it should be listed for rent. And that same research could help us determine what the ratio could be. And we won't know for sure until we get back that appraisal. And yes, and here's another part of this. We can use the existing lease. If someone's buying an investment property and there's already a renter in there, we will be able to use that to a certain extent. Because if the rent is overpriced and we get the appraisal back that's showing less, that could create an issue. If the rental income is lower than what it should be, which in my experience happens more often, where let's say the rent should be 3,000 a month, but the renter's paying 2,000 a month, it's under market. So now we want to rely on the appraisal because that appraisal is going to bump that rental income. And now at least the buyer knows, well, that renter is paying way too little. When are they leaving? And then they start to understand their business decision. But hopefully, are you a little bit more clear, Anna Marie?
Yes.
Okay,
Yes,
good,
got it. Thanks.
good, good. Okay. Okay, so let's go to the other one. So this is also becoming popular in my world, and it's hard money or asset based. Okay. And so here are the basics. This is for home buyers or homeowners that need to access money quickly. Okay. So, for example, how does this affect you as a real estate professional? You have a buyer who's going to go buy $1 million single family house in Coral Gables, for example. And we know that so we're going through the pre-approval process, and all of a sudden we realize, okay, you need 30% down, right? Maybe they're buying an investment property, and we need to make the loan smaller to make sure we ratio. And it's okay. He or she is short on cash. And so, well, where do we get cash from? Well, we go to another property, whether it's another investment property or the primary. What I would do first is shoot for a home equity line of credit because it's going to be it's the rate's going to be a little bit lower, and it's a revolving line of credit, which we'll get into. But in that particular case, I can get someone 60 to 65% of the value of whatever home they have, even if it's primary, that's very rare to be able to do a hard money loan on a primary residence. But in 7 to 10 days, money's in their pocket. That's a hard money and asset-based loan. Maybe they can't do a home equity line of credit because the credit score is not good enough. But he or she still wants to get that other property. They need hundreds of thousands of dollars right now. The hard money loan is a quick fix to acquire this property. And we go back to the very beginning. It's the intention, it's not rate, because a hard money loan is going to be double digit interest rates, double digits, sometimes 12%, give or take a percent in either direction. But someone's paying 12% on a hard money loan. Why? Well, that's where you and I come into play in being their service professionals. We have to be clear on why. Why would they do that? Because it's the only way they can access the money they need to do the thing. What is the thing? What's up to you and I to figure that out before we even got started? Okay. I've got a client right now who just started a job. She owns a $900,000 home outright. She wants to buy a $1.5 million investment property. And she's like, well, what do I do? HELOC won't work because she hasn't been working long enough in her employed job. So we're doing a hard money loan on her primary residence so she can then buy this investment property. It's the exact study case I just shared with you, and it's happening right now. So there's hard money and asset based. It is a loan based off of the value of the home. They're not looking at the income. They're really not even looking at the credit. I mean, they want to know that they're not in foreclosure, but a hard money loan or asset based loan is what's the real estate and how much equity is going to be left over after you get what you want. Hard money and asset based. And I've been doing a lot of these as well. Okay. So conventional loans, this is if you've got a borrower who's W-2 or tax returns, conventional conforming. Okay. You can go as little as 3% down, and credit scores can go down to 620. Now, this isn't really talked about a lot. I know there's a bunch of condos down in Miami, right? We all know that. That condo has to be approved. You might want to write this down. This is I think, a really, really good nugget, especially as you guys scale your business. You're going to have a lot of people who just want to buy condos. You probably already have, right? And how do you leverage with condos? Well, you simply do a mortgage, but here is the red flag for condos is the condo association, right? The condo association is either going to be healthy and not approved, and I can get the whole building approved. I have a couple of lenders that I work with that will approve an entire condo building off of the one transaction that we do together. to be able to go conventional conforming 3% down or 5% down, or even FHA 3.5% down. It has to be healthy. You know, how many condo associations in Miami are healthy where there's no lawsuit? They've got plenty of reserves in the bank, all of their equipment, including water pumps, right, Patricia, the whole water pump thing with the condo. How many are is healthy? And then we have a shot, right? And then we can go conventional conforming or even FHA, right? If they're buying a single family house where there's no condo association but only a HOA, then we don't run into this problem. But when it involves a condo or a townhouse that has condo, it's being managed by a condo, we need to make sure the condo is healthy. But someone can buy a $500,000 condo with as little as 3 to 3.5% down with this credit score, right? That opens up the opportunity for you because at least now you know for sure. And how do we determine if the condo is healthy? Different conversation, but quickly, are they in litigation? Do they have at least 10% in reserves? Those are really the two main questions to ask. Do you have 10% in reserves or in their savings account? And is the property in any sort of litigation, yes or no? And I want to know that ahead of time because the borrower needs to know if it's worth making an offer. And most listing agents don't know that. And if you're listing a condo, you need to find that out. It's very important. Okay. FHA loans, 3.5% credit scores go down to as low as 580. But here's something else that I've been also doing a lot of for some reason. They keep when loans come into my world, I'm just really grateful that I have the wisdom and the creativity to be able to say, okay, I know exactly where that goes. Right. So I have a client right now that's got a 564 credit score, right? And so as a result, the loan needs to be lower. And what I'm sharing with you is if someone has a 500 credit score, there's two things. Number one, they're mortgageable. So if they're going to buy an FHA, they need 10%. Okay, if they've got a 525 credit score, they can buy a house as long as they have 10% down to the purchase price. Okay. And if they have a 500 credit score, why? I'm going to look at the credit report, and I'm also an expert in a credit report and credit scoring. I'll be able to let them know exactly what to do to get them mortgageable. Some people say, well, I don't have 10%. Okay, well, then let's bump your credit score to 580. Here's exactly what to do. And then I give them their homework. And then half the people do their homework, the other half don't, right? They're going to check out. But the ones that do, they become a pipeline deal for you or a pipeline lead where they come back and say, okay, Anna Marie, I'm ready to go again. Craig, let's go shop and take me to buy this, this $1 million house, whatever. Okay. So there's FHA. You can go down to 500 in a credit score. Same thing with hard money, by the way. Okay, VA loans. VA loans are going to be essentially the same for FHA. The only difference is and what's a VA loan? It is a loan for someone who has worked in the military. There you go. If they worked in the military, zero money down. There's no official minimum credit score, and there's also no mortgage insurance. Okay, we're typically going to look at something at least 580. I can go lower than that, right? But this opens it up because literally a veteran, like, and especially like we talked about this in the last training, you guys have thousands of people in your cell phone, thousands, social media, thousands, right? Who have a low credit score, who don't think they can do anything. Veterans, they don't need any money to buy. All they need is the commitment to go buy because zero money down, no mortgage insurance, no minimum credit score, and we potentially can get the seller to pay for the closing costs. A true zero money down. And all you did was say, hey, are you interested in buying? And do you have an idea of what's stopping you? Well, I don't think I can get qualified. All right, talk to Jay because you probably could go from renting to owning in 45 days with $0 out of your bank account. How big would that be? How much do you think they would appreciate you? You have thousands of people in your cell phone and your social media. Okay, so that's the VA loan. Okay, USDA loans. It's really, unless you guys are going down to like Homestead or Kendall, this is just more rural. Okay. But USDA loans are the same as VA loans in terms of money out of pocket. So if someone wants to buy, let's say, an acre or two in Homestead that takes like 20 to 25 minutes to get to a grocery store. I haven't been down there in a while, so I'm not sure what the development has been. Um, but if someone's looking to be remote, right? And by the way, I can do a loan in any state in the country. I can do a mortgage in any state in the country. And so if you know somebody who's in California or New Mexico or Pennsylvania who is interested in doing a loan, I can do a loan there. And so this is more of planting a seed, the USDA loan, because I don't do many of those. Very rarely do I do a USDA loan, but it's available for someone who wants to live remote, North Carolina in the mountains, whatever it is. Okay. Jumbo loans. These are the big loans. Okay. The multi-million dollar loans. There's a little bit higher risk, and here's pretty much the guidelines. If someone wants to buy a $7 million property, instead of paying 7 million in cash, they can leverage, give them a 3.5 or $5 million mortgage, right? They'll be loving you if they know that they have the opportunity. And all you're doing is planting a seed. You're using what I'm sharing with you now to just put in your back of your mind, say, hey, I remember hearing this from Jay Robbins, and if you have any idea or thought you want to do this, you should give him a call. But here's jumbo. Okay. Usually 10% down or a 10% equity. Credit score needs to be at 700 because it's, the lender's writing a big check. Okay. And we're going to be wrapping it up in a couple minutes, and then I want to open it up for questions and answers. And I just saw the time. I know we're about an hour in. Um, so your client's next down payment might already be sitting in their home, and we talked about this in one of the previous slides, that if someone needs more money or needs money to buy their next house, I can get them a home equity line of credit and get that funded in 7 days. It's not as easy to qualify as a hard money loan, but if they qualify for a HELOC, I'm recommending the home equity line of credit, the HELOC, over the hard money loan. And maybe another option is to do a cash out refinance on one of their properties, primary investment, even commercial, to access capital to satisfy their intention of what they want to do. Okay. So this becomes an option. And then renovation and construction loans. Okay. So primary residence, like, you can unlock the ugly listing. It's like if you've got a property where, let's say, and this is going to be really powerful for you guys getting listings. If you're listing a property and, let's say, in great shape it's worth $1 million, but there's 200,000 required because of whatever, the roof has a hole in it, it's a mess, right? You can market the listing as a fix and hold or a fix and flip or a renovation loan, and I have access to those products, right? You're helping your buyer. So instead of your buyer who probably can't afford to spend 200,000, or they don't want to spend 200,000 of their own money to get it up to speed, you market it as an investment opportunity, and then you have someone come in and do a renovation or construction loan where I'm giving them the money to do the renovation after they close. It's important to know that. I do this for investors and people who are buying their primary residence. Okay. And commercial lending 101. It's very similar to residential. It just takes longer to do on my side. But essentially, we're looking at how much is the property cash flowing if it's commercial, right? What's considered commercial, just so you know, is the opposite of residential in this sense. Residential is 1 to 4 units. Residential as a kitchen, bathroom, etc., mainly a kitchen. Um, Commercial is 5 units or more, or anything else that's not residential. Warehouse, hospitality, hotels, restaurants, and I have access to all of it. I have access to a ton of resources, which I'm proud of the amount in the sense that I have access to so many, but I don't call all of them. I know who to call depending on the asset type. If it's a 20-unit apartment building versus a owner-occupied warehouse versus a medical building, versus ground-up construction of a resort, right? I'm working on all sorts of different unique assets. But essentially, we need to know How strong is the borrower? How strong is the business? And then what's the asset? It's really simple. It's just a lot of heavy lifting on my side, which I'm fine with. Okay. Commercial basics. Here's basically what it looks like for commercial LTVs. It's typically going to hover between 20 and 35% down payment on an acquisition. And same thing, if they're refinancing to acquire more, then the LTVs are actually a little bit lower. But this just gives you a range. If someone's going to buy commercial, they've got to have 20 to 35%. And usually it's more like 35% down because the 35% down or the 40% down, to give you an idea, those are going to be bridge loans. Those are going to be quick closings. And a lot of investors need to close quickly, right? Which is like a hard money loan. A bridge loan and hard money loan are similar. And so they're going to be higher interest rates. Um, if you're putting down 20% on a commercial, that's more institutional. That's more of low interest rates longer term, which just takes longer. So if someone has the time, like closing in 3 to 4 months, and everyone has their ducks in a row, then I encourage that. Less money down, lower interest rate. But if there's not enough time for red tape and someone needs to close quickly, then it's going to be 35 to 40% down bridge loan. And again, each situation is different. Okay. And the DSCR requirement, Anna Marie, going back to your question, if we determine that the ratio is 1.2 or higher, that's really good. Simple math. If the mortgage obligation is 1,000 and the rental income is 1,200, that's 1.2 ratio. So if our ratio is 1.2 and higher, we're in good shape. If it's 1.0 or lower, less opportunities, still doable. If it's negative, still can do it, just even less opportunities and the guidelines become more strict. So it's not saying if it's negative, it's a dead deal. It's just saying that we need to restructure it if it's not cash flowing. And it still makes sense in a lot of cases because someone might buy, give you an example. If someone buys an investment property and they're going to Airbnb it and the appraisal shows negative income, okay, maybe their interest rate's a little higher, they have to put down more money, but Airbnb income is going to be 3 to 4 times higher than a 12-month long-term rental. And so even though the rate's going to be higher, it still makes mathematical sense because you're getting 4 times the income versus what the appraisal says, 3 to 4 times as much. So it makes mathematical sense. Okay. And then what's needed, it's more paperwork, financial statements. We can get past that one. I just want to honor our time. Okay. And then there's a skill in being able to match the buyer to the right product, right? And it's just up to you, and you can kind of plant the seed in understanding this ahead of time, right? But you don't need to know this. What I encourage you to do when it comes to me is just give me your trust and don't get too much involved because you already have enough on your plate, right? Between just in life, right? This is the business portion, and we have family and mind, body, spirit, all the different things. And my intention is to make your life easy by doing all of this, but at least you have some insight. So when you come across any of these, it's going to help dictate the path that I'm going to lead them down to put them in the best position. Okay. And so the investor, we talked about the DSCR loan. This is how they scale their portfolio. You become good at this, then which is again, I don't want you to get good at it because it's, the more knowledge you have, the more you're putting on your plate. But this is just a really important product in this environment for anyone who's buying real estate as an investor. Okay. And here's just a simple question. Hey, how's your income structure? Right? And that opens up the door for going a little bit deeper. Okay. And so why this makes you irreplaceable? It's because you're able to stop saying no. You can start taking on deals where the bank says no. You can say, wait, let's not conclude. There are other options, right? And then you have the ability to not only serve, but also you have the opportunity to make a living, right? As a result of showing up and being of service. So just asking you flat out, So when you speak to somebody, just say let's talk to Jay. And by the way, if you want to set up a conference call, I support that. If you want to set up a conference call to hear what I say and how I talk, I'm happy to do that. If you just want to send me the name and then I'll get them set up and I'll report back to you, I'll do that. But listen, I'm showing up here. I'm doing this work and this training. I want to give you more value than you'd expect. I'm hoping this adds value. And in return, what you can do for me is send me mortgage referrals who want and need who want to need a mortgage or might not even know they want or need a mortgage, but as a result of speaking to me, I can share with them, hey, here's what wealth creation looks like that maybe you didn't think about before. And there you have it. And I think we are not even think like this is the conclusion of this training. So before we go, I want to open it up. Does anyone have any questions or thoughts for me at the moment? And I will pass the screen share back to you, Patricia.
Thank you so much, Jay. You're always so full of knowledge. And if anybody ever has a subject that you want Jay to touch on, just, give us a text or him a text and let him know. And he'd be more than happy. He wants everyone to be the best top producer you can possibly be and be there to help you. You can call him, text him anytime. He's got great ideas. And thank you for always being around for us and loyal to us.
Absolutely, my pleasure. And before I hang, does anyone have any thoughts or questions? Is there anything in chat maybe that I didn't see, or is everyone good? Okay, I think we are good to go. Okay, Patricia, any last minute thoughts that I could? Oh, you're welcome, Anna Marie. Thank you for thanking me.
No,
Um,
just thank you for being here for us all the time. And everybody, don't forget about the new development, Kempinski, which is going to be fabulous next Wednesday and Thursday. I think we have a special ChatGPT listing um, class that NAR is giving with all new tools that can help us get more listings. And now's the time. Build that foundation because it's as summer's ending, it's only going to get busier.
yeah, and if I could add one last thing, if I could leave you with anything, just from service professional to service professional, is go record a 30-second to 90-second elevator pitch on a video and stick it on your website and share it on social media. And you'll be very surprised of how many people say, "Oh, I didn't realize that. Yes, I'll reach out." And that could turn into a $10,000-$20,000 commission simply because you took advantage of what Patricia is offering you in filming that video. So that's it for me.
Everybody have a great day. See you soon.
Take care.
Bye.